So today we have an interesting conversation. We previewed it last week. How are you using AI to influence your P&L? Another way of saying it is, where are you seeing the influence of AI in your P&L, and where should you expect it? Where can you see it? How do we think about those things? And so for that, again, let me reintroduce Matt, our co-founder and COO.
Hello, everybody. Super excited to make my AISU, not debut because I was on early ones, but it's been a while. So super excited to be with everybody today. And just by way of reintroduction, yes, co-founder and COO at an early stage startup. That means you're doing everything from mopping out the bathrooms that we don't have to...
Hey, we do in Houston.
Yeah, we do in Houston. Yes, that's why I visit only rarely, so I don't have to do that. But beyond that, invoicing, finance, and all the fun things that go along with owning the finance function. So who needs coffee when you're talking profit and loss statements and how we think about the way you should be seeing, or the way you should be thinking about leveraging AI in your business to drive the business outcomes and the whys behind those business outcomes, including how we think about what we should be doing with the time savings and the resources that we're able to shift and to reallocate as part of those gains within the operation. So really excited to talk a little bit about the why, the what, and the how of leveraging AI like Thread, but AI more broadly in your service delivery to drive better business outcomes and better unit economics in your MSP.
I love that. And Matt and I did work at an MSP. Matt spent 10 years at the MSP on the business operations side as chief of staff. So he's done this for a while. And I love that point. As you all know, obviously there's parts where Thread will show up in your P&L, but this is, to Matt, I think to your point, more broadly, how will AI show up in some of the things that your financial team may be looking at and the executive team?
Absolutely. So again, let's talk a little bit about the why and the so what. The why and the so what is that it's really, really difficult to scale a service business, and it's even more difficult to scale a service business very profitably. Why is that? Because historically, as we well know, fragmentation in the stack, fragmentation in service operations and workflows, and all of the point solutions that we need to plug in to fill those gaps. What does that create? It creates a system and an operation that scales labor linearly with revenue. And so how does that manifest in your financials? It means that just in lockstep or just ahead of your revenue increasing, your costs increase almost proportionately relative to your labor. And that's what's really exciting about the opportunity as it relates to solutions, again, like Thread, but AI more broadly, is that it gives you this digital labor, this digital workforce that automates low-level jobs to be done, and ultimately almost entire functions. In so doing, revenue now can scale independent of or irrespective of headcount to a certain degree. And so if you go to the next one, Mark, this is the dream, right? We're able to create a business that revenue scales independent of the amount of people that we have in the team, because we are taking those manual tasks, those onerous jobs to be done, and we're automating them away, taking that capacity and allocating it to more revenue generating activity and user supporting activity without adding too much headcount to the team. And so obviously this is meant to be indicative. There always will be incremental increase of cost through time, but the goal is to build a structure that you're able to drive additional top line with the same team. And there are a few levers that we think about that you're able to pull through time. So we'll talk a little bit about those, and then we'll talk a little bit about how and when you'll see that manifest in your financials. And spoiler alert, it's not going to be right away. There is a little bit of a lead time, a little bit of a lag time to get to ultimately the place you want to go, as with any transformation. So we'll talk a little bit about these things here in a little bit.
And I think like the decoupling to the headcount for a service business, that's a dream come true. And I think that's why a lot of companies, that's why software companies tend to have better margins, is because it is decoupled, right? You could resell the same product, where in service, the human typically is the product. So you need to scale that fairly linearly.
That's right. Yep. Again, this slide is also meant to be indicative. It's indicative of some of the outcomes that we're seeing partners drive and generate within their own business, leveraging different types of AI assistive and agentic that we talk about a lot on this call to drive certain outcomes. Some of you will be earlier on your journey and potentially smaller scope and scale. Other folks may have blown past this, who have embraced the entirety of the platform and the promise of the technology and automation underneath of it. Also, some nuance as it relates to the vertical that you operate in, right? If you're charging more on a per user basis, it might look a little bit different from a service gross margin standpoint perspective, but these are the outcomes that we're working to drive. And the way that we're thinking about it is essentially headcount supported by billable technicians. So what's the total number of endpoints on average supported by each billable service technician on your desk? And again, models may differ. There may be nuances. If you're in a pod, you might be thinking about that within the concept of the pod itself. And again, it could also depend on the vertical you're supporting. For example, the MSP where Mark and I first met, they focused on financial services companies, hedge funds, and private equity. Historically, more hedge, more recently, more private equity. But the reason that's important is because the entities themselves weren't huge from a headcount perspective, but they were able to charge more on a per user basis for the sophistication of applications that they were supporting. All right, beautiful. So we talked a little bit about the concept of these things and the setup. There are a few areas on the P&L that and before I get into it, many of you may have seen if you're working with Service Leadership Index at all, or if you've used any of the assets from their site, this format is where we pulled from, or that's where we pulled this format from. We added a little bit of additional detail to it to show how we think about where certain items fall in the P&L. And so there are 3 levers that we recommend thinking about pulling. So left-hand side are those levers, and then the right-hand side are the impact of not pulling those levers. I'll leave top-line revenue alone for a second because we'll talk about that more in a little bit as it relates to the awkward teenage phase that I mentioned before, and then beyond that, when you'll start to see return, most likely, from additional investment in sales and marketing. Mostly we'll focus on the next 2 levers, but before we get into that, what I want to call your attention to is the EBITDA down at the bottom, right? This business is not mega profitable. There's not a ton of cash, dry powder that they take home at the end of the day that can be reinvested into growing, reinvested into strategic opportunities, or if they're in the stage of business where it's no longer a lifestyle business for the owner, they're thinking about exiting potentially, you're not going to get a great multiple on that amount of EBITDA. And so what we think about are ways to recompose the service operation to make everything above the line more profitable so that there's more money to reinvest into growth or into strategic opportunities, which in turn will drive more EBITDA down the way. And so we've highlighted 2 levers, and we talk about these two things a lot. The second of 2, maybe more recently, since we've added a voice product, but your dispatcher or your dispatch function. And then if you're doing any after hours, nights and weekends, or business hours overflow on the service desk, we view those 2 areas specifically as opportunities to recompose the service operation, and in so doing, recomposing how you're able to reinvest in the business. And what I mean by that is dispatchers, we know them, we love them, but we also know that it's not typically billable work. It's a non-billable role that's kind of a human shape glue and answer to some of the fragmentation issues that I mentioned at the top. And what that creates is non-billable overhead capacity that's sitting on your gross margin, or that's hitting against your gross margin, and also doesn't necessarily increase that endpoint to headcount ratio. And so the first thing we recommend doing is, of course, implementing assistive AI and agentic AI to automate the dispatch function to the extent that you can, and then take that individual or individuals and retrain them, cross-train them, up-level them into ideally a tier 1 technician, thereby increasing the capacity of that team, ultimately enabling you to support more top-line revenue and more users down the way. And then, of course...
You mean when we were kids, we weren't all growing up and saying, man, when I grow up, I really want to chase people to put in their timesheets and ask them if they can take tickets?
Yeah, I didn't even know what an MSP was until I was Googling what can you do with an English degree, and a business analyst popped up, and there was a business analyst opportunity with an MSP. So I definitely wasn't dreaming about timesheets.
You are now.
Yes, I definitely see them in my dreams. And then the second lever there is the outsourced help desk for those who are outsourcing. As we well know, again, it's another decision, another trade-off that's made for a lot of growing MSPs, in that, do I staff follow the sun? Do I staff 24/7? Can I afford to do that? If I do that, does it mean I have to charge too much for the market? And so the answer a lot of times has been, I'll outsource or I'll offshore. And the trade-offs there are, of course, it's lower cost than staffing, but of course, typically the experience isn't as good because they're not your team, they're not on your payroll, and they may be supporting many accounts. The other trade-off is that oftentimes, depending on the level of and nature of that agreement, they're not actually able to make any changes in the PSA or do any of the work. And so the return that you're getting for that type of arrangement may not be as ideal as opportunities with AI today that enable you to re-insource that function and lower the burden of that cost, even the reduced cost of outsourcing and offshoring. So as I mentioned before, let's say we pulled some of these levers. So as you can see, the outsourced service desk line item goes to 0. The dispatch payroll or time allocated to dispatch is decreased in this example. That dispatch time moved into the technician payroll because we've been able to reclaim, cross-train that individual and move them into a billable type function. What's not changed in this awkward teenage phase is your top line revenue. Because though you've been able to reclaim some of the outsourced service desk time, replace it with a lower cost solution, and you have that additional gross margin to reinvest into sales and marketing, it takes time, right? If we had a magic wand to improve our sales and marketing budget or hire somebody and they add additional revenue for you in a period of a month or a couple months, we would all do that. But of course, and unfortunately, it's not that straightforward. So we wanted to add this kind of awkward teenage phase slide just as an encouragement for folks who may be in this moment of the transformation of their service operation, their service organization, to just know there is no magic wand. As our CTO at the MSP used to say, there is no magic in Santa Claus. Spoiler alert. Sorry if anybody's listening into the call that didn't know that. But you can't just flip the switch with some AI and get the outcomes overnight. So there will be, as with any digital transformation, there will be a period of a month, a couple months where you're starting to see the right things. You're starting to see CSAT scores improve. You're starting to see the output of the team improve. You're investing those dollars in sales and marketing, but you're not seeing the top line yet. So this is meant as encouragement to get through that awkward transformation phase to get to the other side. And there are some very clear signs that you'll start to see when you're getting through to the other side that'll indicate that, hey, this strategy is working.
Yeah, and the big change would be that you're starting to see the outsource, the dispatch start to fall in terms of the cost as a percentage, and you'll start seeing that reapplied into the sales and marketing, but the EBITDA doesn't change yet in this phase.
That's exactly right.
So you've unlocked capacity on your team. Hopefully at that point, your ratio will probably, it's staying the same because you don't have new customers yet, to your point, right? There's like a life cycle, what's your average close time? But you're starting to see that you're now able to reinvest more into this next phase of top line revenue growth.
Yep. And ideally, again, you're providing a higher level of service, higher touch service with the same team with that unlocked capacity. So things like retention rates and CSAT are improving in that middle phase, even though we're not closing new or additional business quite yet.
And please feel free to drop in if you have any questions as we move on.
Beautiful. And so this isn't the end state, but this is a state that we think we've seen folks get to, and we believe that folks will get to pretty quickly following a progression like this, which is you start to see more customers close and come in top line. You don't have to add additional headcount to be able to support that revenue. So if you look at the gross margin line, it's increased about 10 points from the prior awkward teenage phase. In turn, your bottom line, your EBITDA margin has increased quite a lot, right? In the first couple of slides, we're sitting at about $17,000 a month in EBITDA there. And in this example, we've grown that 27%, or not, by 27,000 without growing the team, which is really strong and really healthy. In turn, again, it'll give you a number of opportunities. I think the art and the science and the strategy beyond that point is, do we continue to pump a lot of money into sales and marketing and try to continue to grow advantageously with those scaling advantages through time? Or do we look at things like maybe not R&D, but maybe value-added services or services specific to the vertical in which we're delivering service? And so again, using the MSP where Mark and I met as an example, they focused on hedge funds and private equity and regulated organizations. And so with additional profit, they were able to invest in additional services. They built their own SOC. And MSSP practice. They stood up a compliance practice and organization that had due diligence services and business continuity and resiliency consulting services specific to that vertical. And it was a great way for them to create additional revenue streams that in turn fueled the top of the funnel because they were able to market those additional services to the businesses that they were trying to work with.
Or even it unlocked our ability to just be able to do things like follow up and see if there's hardware that needs refreshing on firewalls, like even things like that, to proactively provide services and have the capacity to create proposals and do that was a massive unlock for us. I know whenever we were trying to hit our EBITDA goals for the quarter, we were able to because we had more built-in capacity. There's a great question from Joshua. We'll get to that. But from Chris, we use one. Let me highlight this. Brian put me on the spotlight capabilities. So we use one dispatcher coordinator, but I don't see how we could go without at least one for scheduling engineers to go on site. I don't trust engineers with scheduling of other engineers. And if you look at the way that Matt shows in his P&L here, we don't believe that the right answer is to go, again, it depends on your service organization size, to go to 0 dispatchers. We believe that there should be a dispatcher, but that dispatcher should be more of a AI supervisor for the system, making sure that it works well, to have that feedback loop where you can improve on prioritization, categorization, continuing to do things like potentially linking up with bookings and automating some of these scheduling processes versus actually just ticket pushing like the the train pushers in Hong Kong to fit people into the train. Matt, I don't know if you want to add anything to that.
No, yeah, I think that's right. I think there's opportunity to also like allocate a portion of that resource's time towards technical work, and whatever portion remains for making sure that the AI trains that they leave on time. And so we would be able to split the allocation of that resource's time into the appropriate buckets, both more value creating and billable work and non-billable work based on the work role and work type that you're leveraging in your PSA.
And before we take the next question, the goal here is that you will be able to have better ratios that lead to better service gross margins. And the unlock here, right, is to grow your top line revenue by attracting customers. I would love if everyone can drop in what their growth rates are that you guys are forecasting or making as goals for 2026 in the chat. And what is the percent of labor growth that you think you'll need to support it? Hey, I want to grow 10% next year, and we're expecting our labor costs to increase 5%, or maybe 8%. Would love if folks can share that. I think it'll be really helpful for everyone as we go and highlight the next question. Is that okay by you, Matt?
Yeah, perfect.
All right, Matthew Linn. The question's from Joshua to Matthew. I've been working on, I never call you Matthew. I've been working on the ROI P&L lately.
That's my government name.
So perfect timing. It seems like getting Ask Magic out there has meant we have less tickets open, but I've had trouble getting Autotask to show me. I assume show me why, or understand that why that's happening. Tickets aren't taking less time on average to close or getting closed on less business hours. Almost seems like vapor time savings. I want to say vaporware for some reason, but love to get your perspective.
Yeah, and I don't think so. If I'm understanding correctly, the fact that there are fewer, so because the ticket doesn't exist, it's hard to quantify the impact of having the agent and having opportunity to chat with Magic out in the wild. It's making it difficult to quantify that kind of deflect percentage. So that's one piece. And then the other piece is that we're not seeing necessarily efficiency gains on the tickets that do come through to the service desk. So in so doing, it's seeming like we're not actually gaining time. And so there's a couple components here. The deflection / AI auto resolution side of things is something we're thinking about a lot, and it's going to be a core KPI for us into the future, whereby we're quantifying the number of zero-touch tickets that are handled by the agent end to end. And oftentimes it's not, doing the work per se, but oftentimes it's an inquiry or a question that comes in, whether it be about the account or how do I do this XYZ in Microsoft 365, or guides them to or through a workaround that gets them to the same place. So and obviously beyond that in the future, as we do more and more in the lift or facilitate more and more of the lift in the platform or through partners like Pia and Roost, that percentage will increase quite a lot through time. So that's one area. I'm not sure, we can maybe talk a little bit offline about how to quantify those that actually never make it to the desk. That's an interesting point. The other component is, I think, being able to close the requests more efficiently with a higher touch and do so more proactively are areas where you'll see probably the impact on the CSAT side of things and in terms of the sentiment of the account overall.
Yeah, and I think this is, and I love that you showed this teenage phase. I think, Joshua, you're in that early stages of seeing ROI. What we and maybe there's a kind of a service delivery aspect to this that comes in before even the P&L, because there's a lot, to your point, what you're seeing is that you used to have a lot of open tickets. Now you're not seeing that backlog, which means you're getting more resolution. And what we've seen in the analysis that we have done, there's a correlation between how long tickets are open and the likelihood of that customer churning. So I think what you're seeing is that people are now looking at as issues are coming in, people are looking at those issues more holistically and likely finding patterns and closing things out that haven't been closed out before. So if I was to back into the P&L, I would say that your service revenue and your retention of revenue is what's going to show up, that your customers are happier because there's less open tickets overall.
And I don't want to bury the lead or talk too much about things that'll come in the future, but we are working on concepts for deeper analytics that hopefully will bridge the gap there in providing some of the proof points that you're looking for.
That's all right. We're certainly thinking about them. And Matt, thank you so much for joining us today. Excited to have you as an active participant